Hey there, folks. Greg Shepard here, S&A Financial Services. In today's video, we're going back to the basics. We're going to talk about the guarantee period option, 2015 guarantee period option. A lot of you are getting tripped up, a little confused, if you will, about what it is. Okay, so hang tight. We'll get into it. Okay. For those of you that don't know me, again, the name is Greg Shepard. Drinking my caffeine at 2 o'clock in the afternoon on a Friday, which is not advised. Specialize in helping folks all over the country just make sense of these TIAA accounts. Okay, like I said, we're going back to the basics a little bit. Let me just kind of shoot from the hip here. So we got the guarantee period option. A lot of you are under the, well, I'm not going to get into that. So I'll tell you how to use it, okay? It's very simple. Typically, now if you have a spouse, a married couple, right? You're going to tack on the 20-year guarantee period or the 15-year guarantee period, usually for, let's call it insurance for the sake of the children. That's a very common scenario to do this. Now, all it states is that when you start that or initiate that lifetime income, okay, let's say you do it today. We're in year 2025, okay? You tack on the 20-year guarantee period, you are married. That means your kids will get payments before or if the two of you die, you and your spouse, prior to 20 years. So if you started right now and the two of you pass away in 10 years, okay, 2035, that means the kids, in this case, kid or kids, are going to get payments, those payments, until 2045, the remaining 10 years. Okay, so both of you and the spouse, live longer than 20 years, kids get nothing. Okay, simple as it's as simple as that. Now, some situations warrant some research. What I mean by that is what I've seen in the past is that you'll have a female, okay, female married to a male, and the male is older, 10 years, something like that. Do me this favor, okay? It's not a one-size-fits-all. These actuarial formulas can get a little wacky. Go into the Retirement Income Illustrator. If you don't know what that is, you can contact me or Tia, of course, and have them run it. I want you to do a single life annuity option on the female, 20-year guarantee period, and we got the husband, in this case, older husband, as that 20-year guarantee period beneficiary. Then, comparatively speaking, run a joint life survivor benefit option, 100% paid to spouse. Remember, we've got a female, older male, and just compare the two, okay, and see, if you're a female, married to male, male's 75 years old, you're 65, you're retiring, and we tack on a single life annuity option on you, 20-year guarantee period option on the husband, he's 75, 20 years down the road, what are the odds, right? Sorry, guys. So it might be advantageous to look at that option. Typically, the single life annuity option will pay you more, but you start tacking on the 20-year guarantee periods or 15-year guarantee periods. The actuarial formulas, folks, are, even the TIAA reps will say, they sometimes have to go to the back office to confirm or maybe explain some of these equations, okay? Because a lot of times it doesn't conceptually make a lot of sense. So run all your options that, even if you think it won't be advantageous to you, run it, okay? Now, kind of piggybacking off some of this, I've seen it, folks, when you run that joint life survivor benefit option, the 100% payout, depending upon ages, okay? Again, actuarial formulas. A lot of folks won't run that 100% payout to spouse because they're afraid the payments are going to be just crushed compared to the 50% payout. Run those numbers, folks. You'll be surprised that, again, given your ages, there may not be a huge difference, and it's great insurance for the remaining spouse or surviving spouse upon if you predecease that husband or wife. Now, what was I going to say? A lot of times, again, not one size fits all. This is not investment advice. It's just my experience and things I've seen for the last 20 some odd years. When you tack on a 20-year guarantee period, okay, so you're married, okay, husband, wife, and you want to tack on that 20-year guarantee period for whatever reason. I don't see that a lot. I'll get to that here in just a second. I see where it typically knocks down your payments while alive, by about 10%. Around there, folks. Don't send me an email and say, hey, I did that and it knocked my payments down 15% or vice versa, knocked it down only 5%. Roughly about 10% when you tack on the 20-year guarantee period, and there's two, husband and spouse, basically are trying to cover the kids. On that note, we being clients that come on board here, we don't do a lot of guarantee period option strategies, okay? Typically, if we're initiating lifetime income, it's not more than 40% of the total assets. Typically, we're like 20, 25, maybe pushing 30, but 25% is kind of the wheelhouse. And what I always tell folks, again, to come on board and folks, reconfirm with me, is that the kids will be fine. You all figured it out. I had to figure it out. Monetarily speaking, we're still trying to figure it out, right? So, and there'll be other assets that can be brought down to the kids, okay? So, be cautious. Just my opinion, be cautious. If you're married, tack it on the kids as a 20, 15-year guarantee period option. Unless there's some ancillary situations, which there always are, okay, that I've dealt with. So some of these, sometimes concerning health. So there's always these ancillary issues that might come into play. But generally speaking, we're not tacking on the kids as that guarantee period option if you're married. Okay, feel free to reach out to me, but it's really not as difficult as a lot of you are making it out to be. But feel free to reach out to me again, and I will do my best to get you squared away. All right, folks. Greg Shepard here, S&A Financial Services. Go out and have a good one. Take care. Bye-bye.